Hey guys. So a couple of weeks ago, I wrote this article called 10 Prophecies for the Web3 Age. In this article, I basically wrote down a bunch of things that I think will be happening in the next, I would say, 10 to 20 years. Directionally wise, I'm not saying like precisely it will happen in the way that I predicted, but I think these are more or less the things that I see like in the train will be happening as the Web3 technologies take hold in society and being adopted by more and more users in the mainstream. So after this article, again, I will post it in the comment in the link, post the link of the article in the video description below, okay? But I got a lot of questions on this article and also on the article that I posted on Wired recently about how to think about these, layer one blockchains, proof of stake blockchains as metaverse national economies. So there are a bunch of questions about these, and I'm going to go through some of them today because there are really a lot of them. So let's get into them. The first question is from Robin Land. How about tokenizing commercial real estate debt? So this is regarding to my comment that I said, actually, the first prediction I wrote down is hyper tokenization of everything. I think all the assets that we know as assets today in the traditional asset markets, real estate, bonds, stocks, in fact, anything that you can have a cash flow attached to it will be tokenized in the future. Why? Because public blockchains is where the liquidities will be in the future. And it's just like, in the Web2 age, everybody has to go on social media, whether you like it or not. Everybody, a lot of people I know, like just absolutely hate social media. But still, if you want to get known, if you want to communicate your idea, you have to be on social media. And same thing with Web3 because it's a internet of value exchanges, right? So if you want to acquire capital, if you want investment, you have to be on the blockchain. So that's the internet analogy that I'm seeing that I expect to play out for the Web3 space. So this question, how about tokenizing real estate? But but the thing is, these tokenization, it goes through stages, right? First, you obviously you have the lower hanging fruit that are assets that are already native on-chain metaverse assets, like maybe blockchain gaming and NFT assets, or digital art, and the Bitcoin and Ethereum of the world. That's needless to say, right? So those will be the first batch of tokenized assets, or the new assets that are originally created already in token in the hash token form. But how about these traditional assets? I think eventually they will be on chain, but things like real estate, what I expect will be really the last frontier. It will be the laggers of the movement of moving tokens on moving assets on chain. Why? Because this is a space that is heavily regulated. You can see the same happening in the Web2 space. The two actually very, very important sectors that really need disruptions and digitization can do a lot to improve productivity is healthcare and education. But you actually don't see those two spaces are evolving or being digitalized very, very slowly because they are heavily regulated sectors, especially healthcare, right? So everybody complain about healthcare so expensive, so inefficient. If we introduce like web technologies, there's so many, efficiency gains that can be made. And last couple years was the COVID situation. You actually see the telehealth space grew by leaps and bounds because of this exogenous shock that actually expedited the trend of the industry. But overall, you've heard about digital education, digital healthcare for so long, but in fact, the sectors, the actual digital economy part of these two sectors are extremely small compared to the traditional healthcare and education. So what I'm saying, I think this will be the same for moving off-chain assets on-chain like real estate, because because I think the fundamental roadblock here is a lot of legal rights issues. Like right now, if you have an NFT of a house, right? You obviously, it's very easy to create an NFT of a house. Anybody can do it. But the thing is, what does it even mean? If you create an NFT of a property deed, it's not the deed itself. It's only the property deed. That piece of paper is being recognized by the country's legal system. So that NFT of your deed is not being protected by law in any case, and it's not being recognized by law as a symbol of the property right. So holding that NFT of a house means what? It's extremely it's extremely unclear right now. It definitely doesn't mean that you own a house. That's for sure. In the legal term, right? So that's what I see is like a lot of those legal issues are going to be very thorny issues that's going to take a long time to sort out. And these things, like legislations and the legal changes, it's very, very slow moving variable that's going to definitely be laggards of the system. So, for example, I know some projects right now they're trying to do on-chain mortgages, right? So, like there are different projects that are trying to do this. You issue token to collect capital, collect funding to either buy houses or to do mortgage lending to actual people who buy the houses, and the mortgage payment. Then you use the mortgage payment to pay back as cash flow for your token holders, or you lend out the houses that you buy. Some of the other projects, you lend out the houses you buy, and you have rental payment that's being used as cash flow for your token holders. Now, all of these things sound very good on paper, right? And it sounds so simple, but in reality, it's a lot of legal issues, like I just talked about. And for example, in the case of if you tokenize a mortgage, what does it even mean if your house is in default? Like who has the right of the house, right? Is that a company that issues the token and has the right of the house? Then what does it mean for you as the token holder? You don't have any claim on the house at all, right? So all these things, it just requires a lot of working around the legal system and probably signing a lot of paperwork, even if you buy the token, which sounds like a simple thing. But you definitely see the benefit, right? The benefit is you definitely lower the entry barrier for the retail investors, and you introduces more liquidity for the average investors. So if you invest in like a mortgage-backed security, first of all, not everybody can invest in those, right? So entry barrier is higher, and also the liquidity is lower. But with the token, as long as you have a automatic market maker, the Uniswap or whatnot somewhere, and you can trade a token, someone has a liquidity pool for it, you have liquidity from day one. So these definitely makes the entry barrier lower, makes these assets, these cash flows more accessible for average investors and make the assets more liquid. But again, a bunch of thorny issues behind it, right? So basically legal protection utterly lacking for stuff like that. For any project that's bridging off-chain with on-chain assets. So it probably takes many years, just like your healthcare and education situation. Second question, this is from Timothy L. Would Bitcoin suit what? Let me read this. I need a bit of context. Okay. Okay. And there is another question that's similar from Lorenzo G. What about Bitcoin here? Seems pretty obvious. Why don't you cite BTC? I see. Okay. So this is respond to another prediction that I made in this article. And I said there will be, the emergence of super currencies on chain. And so by super currency, I mean like maybe one or two, definitely no more than five. I don't think would be more than five of those global currencies that will be used as a medium of exchange on chain, like across the globe, across multiple countries. And you see this right now, the most dominant super currency on chain, on any blockchain platform, is USD stablecoin, right? Tether and USDC, and maybe some of the algo stablecoins, but those are also US dollar stablecoins. So that is really the number one super currency that we see on the blockchain today. And you need these super currencies because once you have so many tokens, well, for multiple reasons. One obvious reason is obviously, crypto is a very volatile space right now. All the token prices that go up and down like crazy every day, right? So you need some kind of relatively stable measuring yardstick as a measure of value on chain, so that you can exchange tokens. And US dollar is being the strongest fiat currency in the world that's serving the purpose right now. And also the more important reason is actually because there are so many tokens, you have thousands of crypto assets being traded every day, right? So in order to create liquidity among these tokens, it's very complicated if you don't have the kind of intermediary asset like a USD stablecoin. Because if you don't have that kind of bridging asset, essentially, you will be like creating, trading pairs between any two of those crypto assets. That means if you have n tokens, you need like n times n minus 1 divided by 2 trading pairs. So that's like an extreme segmentation of liquidity, right? It's extremely inefficient. But if you have a on-chain measuring yardstick like USD stablecoin, you just need every token have a liquidity pool with USD stablecoin, and then you can trade using that stablecoin as your intermediary asset to trade across different crypto tokens. So it's way more efficient. So what essentially happening right now is blockchain has essentially created another brand new use case for US dollar. Now, US dollar already is like a most coveted fiat currency in the world, especially in developing countries, in emerging market countries where the local currency is not that stable or is not that credible, right? People in those countries, they already want US dollar. And now with all this crypto trading, it's really creating this another use case, brand new use case and market demand for US dollar stablecoin. And so that's why you're seeing, I was saying US dollar is the number one super currency in the world, and this moat of this competitive advantage of US dollar is not going to go away anytime soon, because these network effect is just a compound add to itself. Because when you already have a US dollar that has the deepest, thickest, the biggest liquidity vis-a-vis any other tokens, right? It just naturally draws people to use stablecoin, use US dollar more, because who wants to trade a pair of tokens that has thin liquidity, right? So you definitely want to trade tokens that are more liquid, that gives you, less of like for most investors, unless you're traders like trading those arbitraging opportunities, right? For most investors, you don't want to be, you don't want a huge bid and ask gap when you trade, right? You want a liquid market. So that make people gravitate towards, using US dollar more. That really adds on itself. It's a network effect that is self-reinforcing. So in that sense, I said US dollar will be the super currency, but you probably also will see the crypto native super currency if we will have a stable representation of the value of goods and services for on-chain purpose that is native to the crypto world. So I think that will be happening. So I think this is where these questions are coming from. So people are asking, would Bitcoin be that super currency? And I think if you watched some of my previous videos, you probably guessed my answer now. And my answer is no. Why? Because it really I think Bitcoin right now it's already established itself pretty well as a store value asset, right? But that is a totally different thing from a medium of exchange. And to be a medium of exchange, you need a stable valuation. You need the price fluctuate way less than what Bitcoin's price volatility is currently, right? So you really need something that can represent on-chain, represent the unit of account for goods and services being offered on chain, but at the same time, it's not like fluctuating a lot. Okay, so because as a measuring tool, it's like if you have a yardstick, you that the length of the yardstick itself, it doesn't make sense for it to go, longer and shorter, every hour or every day, right? You want it to stay constant. So that's why I think Bitcoin is not going to serve that purpose. Now, some people will say, oh, the price is volatile because Bitcoin is still a very young asset, and in the future, the volatility will go down. I don't think that will happen, actually. I think the volatility will continue being high. It will probably go down, yes, but it will not be so low to the extent of that you can use it as a measurement, as a reliable measurement of value. I wouldn't be surprised if you go down to the volatility level of a large cap stock, but still that's not good, not nearly good enough. And the reason why this is, I don't think the valuation is going to be why I think the valuation of Bitcoin is going to stay volatile is because there's no underlying economy that's supporting the demand of Bitcoin. The fiat currency values, especially for the currencies of large economies, their values are relatively stable because the underlying demand for those currencies coming from real economic activities are relatively stable, right? You have so many numbers of transactions happening in the United States or in the European Union every year. And that amount of transactions is relatively predictable, right? The GDP growth always, about 2 or 3%, 1 to 3% every year. So amount of transaction always grow every year, but it's not a hugely, a wildly fluctuating number. So, and that is the fundamental demand that is supporting the value of the currency and supporting the demand of currency. So because the underlying activity is stable, that leads to the valuation of the currency being stable. Let alone that central banks also sometimes try to do open market operation to smooth out the volatility of their currencies. But really that is the small part of why the valuation is stable for most of the good fiat. Okay, and Bitcoin doesn't have that, and it's so far away from having a real underlying economy, and I don't think that will ever happen, actually. So this goes back to some people, actually I said something like that on Twitter, and some people were trying to say, okay, how about Lightning Network? You can use Bitcoin for transactions. There will be an economy built on top of this. Well, what I think is, whatever you can use Bitcoin to do, you can use stable coins like USD stable coins to do better. You can use the USD stablecoin to transact cross-border or send remittances or do whatever, settle payments very, very easily and very, very cheaply. Well, on Ethereum it's probably a little more expensive, but on other newer chains it's very cheap. So it compared to if you were to use Bitcoin to make transactions, right? Some of the Bitcoin payment applications these days, what they're trying to do is you pay in one currency and they exchange their currency into Bitcoin, right? And they send the Bitcoin to the destination wallet, and they exchange that Bitcoin into another currency. It's the recipient currency. So in the process, you incur this risk of exchange volatility, right? So as we said, the Bitcoin is still relatively volatile, currency. So versus stablecoin transaction, you do not have to make these conversions, most of the time. So you do not have that exchange rate risk. So once you have that exchange rate risk, you have to be whoever's making that payment transaction have to be compensated for that risk, right? So usually it adds to the cost of that transaction. You may think that's a small cost, right? And it's probably a smaller cost compared to the traditional Western Union or something like that. It's very, very inefficient, payment processors. But compared to stablecoin transactions, that is still a higher cost. So I just don't see how this is going to compete. So I think you go as a currency that does not have the underlying stability. You want to gain a underlying demand from real economy, basically go from 0 to 1, while you have this other competition right after you, which is stablecoin, which is already stable. You in order to cross that chasm from 0 to 1 is extremely difficult, and I'm just not positive about that. Okay. Instead, I think what will happen is, so we may have the on-chain native stable coins that are not pegged to US dollars, but instead pegged to some kind of indices of the value of goods and services in the economy. So an example is, the new FPI token from Frax. From Frax Finance, they have this new token that is trying to track the, CPI index using this token, right? So I think this is a more sensible approach. Because this is like you're already targeting the use case of being a stable medium of exchange, okay, while being on chain and not dependent on any fiat currency. So keep in mind, because the US dollar value is stable because someone is trying to manage it, right? So whether they do a good job or not, that's a different question. But the Federal Reserve is trying to manage the value of the currency to make it relatively stable, measuring your stake relative to CPI, relative to inflation. So basically right now, the crypto economy is basically piggybacking that by, pegging the value of the stablecoin to US dollar, knowing that someone else is managing the value of that, is stabilizing the value of US dollar, right? But over time, you could have these on-chain native crypto tokens that directly track the value of a consumer index or a basket of goods and services on chain. So I'm actually more optimistic about that type of approach. But whether they get adopted or not, that's a totally different question, because this is still a very, very, very new thing. Okay, so that's that. Okay, next question from XBit88X. Do you imagine governments will want to use public or private blockchains for their CBDCs? So this is in response to something I said in my Wired magazine article. I said these on-chain economies, layer 1, layer 2 blockchains, they have their monetary and fiscal policies that are being programmed on chain. So it's separate from any human discretion, and therefore is more easily enforceable. And that is one advantage over some of the more discretionary fiscal and monetary policies that are executed by governments in like a traditional economic policies, right? So that's maybe something I think, the issuers of CBDCs, because governments all try to do their CBDCs these days, maybe that's something that, governments can look into in thinking about how they actually structure their CBDC. So in terms of where they will actually issue their CBDC, would they use the public blockchain, or would they use their own separate private blockchain, or their just, separate individual chain? I don't think most of the governments are looking to issue CBDC directly on Ethereum or Solana of the world. Why? because obviously they want more control, they want more customization, they want to be able to control every parameter of this whole process, and that is I think that thought process is completely natural, right? They want to control the programmability, they want to control the security, they want to basically be in charge. But the thing is, I think that's actually a mistake, because I think a lot of these governments, they think they're going to issue a CBDC and that will be that, and call it a day, and that will be their comeback to the increasing adoption of crypto. But the thing is, if you read something I wrote earlier, it's like the biggest threat to these national currencies, traditional national currencies, is actually US dollar stablecoins, for the reasons that we just talked about, because US dollar is really becoming a super currency in the crypto world. So, and the advantage of stablecoin is it's so easy to use, right? You can use it on, it's being represented in all the public blockchains. And if your CBDC of any country, non-US dollar country, if it's not interoperable with other on-chain tokens, what is the point? So how are you going to counter the increasing adoption of US dollar stablecoin? So I don't think most governments are thinking this part through, actually. I think it will be a mistake. And it'll be a mistake that people will realize this later and try to backtrack. At least that will happen for some countries. Because I think if you have a CBDC, you better make it interoperable in one way or another with the public blockchain assets. Even if you don't issue it on Ethereum, Solana, or Avalanche, you issue it on your own blockchain, you better make it interoperable. That will be the way to go to actually make the national currency, have some adoption and do something in the web3 age. But that will probably be for another day for the national government, for most national governments. Okay. Next question on Anders L. Do you think governments will allow ID-less crypto wallets in the future? You don't think they will pull the Terra financing or AML card? Or do you think they won't be able to uphold such a law? So this is responding to what I said in this 10 prophecies article. I said in the Web3 age, you will have these cross-border capital flow would not mean much, will lose its meaning, because it's very hard to track these crypto wallets because they are ID-less and faceless, right? So that's in response to my comment regarding that. But the thing is, even if you attach ID to crypto wallets, you do not change the nature of the fact that the crypto wallets are nationless, right? So I have an Ethereum wallet. It's like I take it with me wherever I go. It doesn't make sense to say I have an Ethereum wallet in the United States or I have an Ethereum wallet in Canada, right? So traditionally, how do you count cross-border capital flow? If I have a bank account in a bank in the United States, and I move that money from my US bank account to my Canadian bank account, that is capital outflow, right? It goes from a US bank to a Canadian bank. But the blockchain space created this tier of value exchange that sits beyond any national border. It's completely, it does not know any national boundaries, right? So what does it mean if I move? The government can know, this wallet is attached to Tasha, it's my name or my face attached to this wallet, but does not change the fact that if I move token from this Ethereum wallet to some other Ethereum wallet or to my Solana wallet, it has nothing to do with cross-border flow. How do you count such things, right? So that's why I said these concept of cross-border capital flows will gradually lose its meaning in the Web3 age when you have this gigantic tier of value exchange system that's sitting on top of any geographical boundaries. It's like, the internet, right? It's borderless. So you don't have the Canadian internet or the US internet. You can browse the website of whatever a website is on the internet, right? So but so the thing is, in traditionally, why do governments care about these cross-border flows? Because it tells you a lot, it gives you a lot of information, right? So you don't want like a volatile short-term, like volatile changes of cross-border flows in the short term, because that usually, it usually implies that it will cause some instability to your currency valuation, or it will cause some stability to the economy because you have financing sources being pulled out from the economy, or you have a influx of financing resources coming into the economy in the short term that causing some kind of causing some distortions to the financial system and to asset valuations. So traditionally, when you have these dramatic changes in the short term in capital flows, whether it's outflow or inflow, it's considered a kind of complicated thing to manage. That's why government wants to track those things. Then, and also obviously you don't want to have like consistent capital outflows, because that's investment resources going out of your country. So that means there's something going on there that's negative. So that's why traditionally governments track these things. But you see what I'm saying is, in the Web3 age, it's harder and harder to track these things, and it becomes meaningless also to track these things. So what I think will happen is governments will have their own blockchains, or wherever their CBDC is issued, right? It's probably on their own chain. If they're smart, they make it interoperable with other chains. But you will have to count the equivalence of capital flow in the physical economy. The equivalence to that in the Unchained economy would be the flows, the TVL changes, to and from your national blockchain. So I imagine your national blockchain will be where most of the domestic activities happen. You will encourage your banks to build on your national blockchain, and your CBDC will be issued on your national blockchain, and people will transact using that chain that primarily, concentrated in a geography, in a jurisdiction that is called a country, right? So values flowing in and out of that blockchain will give you a measure, kind of an equivalent measure of your capital flow in the physical economy, and that will be the way to track, which is pretty clean cut, easy way to track. That gives you an indication of how much money is flowing in and out of your country, so to speak. And interestingly, this is also kind of an analogy with the physical economy. If you see this, like people track these for the on-chain national economies, that layer one chains, right? People talk about, okay, how much the TVL, how much inflows and outflows into these chains. And it actually has some kind of a relationship usually with the token price of the underlying blockchain. So if you see, like, for example, I don't know, so Solana TVL goes up a whole lot, or Solana NFT, transaction volume goes up a whole lot, it's usually bullish. People consider bullish for the Solana token, and you see Solana price, Sol token price go up, right? Essentially, the Sol current national currency price exchange rate appreciates. So that's exactly what you see actually in physical economy. It's like if you have capital inflow into the country, it usually means currency appreciation for the national currency, and vice versa. If you have a lot of capital outflow, it's depreciation, or the local currency loses value. So I just find it so interesting, these on-chain and off-chain counterparts, these analogies, that work in a similar way. Well, they don't work in exactly the same channels, but actually it's a very similar pattern, which is interesting. Anyway, so next question from from Glad8, or how long do you think before this becomes a reality? I guess he means like things that I was predicting in my article. I would say, well, obviously I made a lot of I made a lot of predictions in the article, so I don't think any of those things will happen in the same time frame. And also, this is not black and white, right? So it's a gradual process. Like they say, people overestimate how much it can happen in 1 year, and underestimate how much can happen in 10 years. So I think it's the same deal. It will be a gradual process. It won't happen overnight, but when you look back, it will be a sea change. So I would say maybe 2035 to 2040 will be the time frame when I think most of these ideas will have would have manifested to a sufficient extent that you can observe those, that's actually observable. Because if you look at how much the internet or Web2 technology have proliferated, right? So the Web2 space, you started hearing about those in the early 2000s, right? So, and it really becomes a kind of a mainstream adoption really happened maybe like 15 years later, I would say by around 2015. That's when you start seeing a lot of those Web2 stocks. Actually, the fan stocks started doing really well starting, I would say 2013 onwards, right? So I will give it 15 years, because right now I think we're close to the 2000 of the internet. Now, you may argue crypto adoption is much faster than the internet, so it shouldn't take 15 years. But I think specifically regarding the things I was predicting, because a lot of those, not just involving blockchain, it also involves a lot of behavior changes in the traditional economy, like regulation changes, regarding like a real estate laws and the property rights laws that I just talked about, right? So I think those will happen slower. So I would say I would give it another 15 to 20 years. Yeah, I'm sorry to disappoint if you think that's going to be faster. It could be, who knows? Okay, next question. Travi JB asks, it already seems like knowing how to do basic investing puts you ahead of 90% of the general population, and knowing digital native investing probably puts you ahead of 90% of that remaining 10%. My question is, how do you address that knowledge inequality? Okay, so this is responding to what I said in the article. I said in the Web3 age, everybody will be an investor because there are multiple reasons. First of all, you have the Web3 is kind of tokenization, financialization of everything, right? Everything that has a cash flow, everything that has value will be tokenized, will be financialized. So there will be this, outburst of a number of assets, number of things that you can invest in. So it's like internet create this explosion of information, right? You have way much more content than you can ever consume. Way more information than you can ever consume. I think this was what happened in the Web3 space. Right now you have like 10,000 crypto tokens, and people think that's a lot, right? But we haven't seen nothing yet. We have it's only a very, very small percentage of the assets in the world is tokenized right now. So we are going to see this explosion of assets, just like we see an explosion of information in the Web2 age. So that means it's going to take so much time and energy to just to gather information, to evaluate those opportunities, to actually, think about how you would allocate your portfolio. So that's already like more than a full-time job. If you consider, it's hard to keep up with crypto these days, imagine if you have 1,000 times, 10,000 times more types of assets in the space. So there really requires more than full-time job. And on the other hand, you see that the nature of work is changing, right? We have a lot of machinization, automation that's taking away a lot of jobs, and we will have less and less jobs in the future, and jobs will be done more and more efficiently. Productivity growth is it's a continual going to be a thing. It's going to be on the way up, right? So working hours will be going down, whether it's across the board or just in some segments of population, or some segment of population may not have a job at all. Job in the in the sense as we know it in the 20th century sense of the job, right? So that means you have more time, and you have more things to manage. You have more things to do for your portfolio. So that's why I think everybody will be an investor. At least a good chunk of the middle class will be a investor class. You used to have stay home mom. I think in the future you have stay at home investors. It could be the mom, it could be the dad, it could be the grandma. I don't know. So I think that corresponds to that. This reader's question is, how do you address the knowledge inequality? Because most people do not have that, is not equipped with that knowledge to actually make good judgment on their portfolios, right? So I think that's a legit point. But the thing is, you see, it's Web3 is not like a panacea, or it's not a utopia world, right? It's not like I think some of the technologists, like positive, a lot of VCs or a lot of thought leaders in the Web3 space tend to see this as if it's a cure-all, drug of any human ills in society. It's definitely not. You always have inequalities in society, and one of the inequalities caused by the inequality of knowledge, right? But I do think at least the playing field will be more and more levered because of Web3, but it's not going to make the inequality go away. So an analogy to this, in the Web3 space, I don't know if you remember 15, 20 years ago, there's this very popular theory about long tails of internet. So this very popular theory says, with the internet, we are going to have, equality of creators and products, because the long tails of products and services will get a lot more attention than in the traditional economy. Why? The argument is that if you go to like a physical supermarket, there's shelf space is limited, right? You have one aisle in a supermarket, you probably put 200 products on your shelves. So if you're not on the shelf space, you do not have a chance as a product. And in the supermarket, you only have so much real estate, you can only stock so many products, okay? But with the internet, your catalog is limitless, right? Your inventory is at the back end, it's not consumer facing. All the customers see is tens of thousands of whatever products that you have. It's like the Amazon is the web mall. It has so much more collection than a traditional supermarket, right? So the argument is that because the selection is so wide now, it creates the opportunity for exposure for those products that's at the tail end of attention span. Those niche products, those products that don't have a brand name, but actually is useful or fits a certain need, they will have more of an opportunity to get ahead. So in that sense, internet is, creating equal opportunity for a wider set of products and services and, content or so on and so forth. So sounds very good, right? Does that actually happen? I think there are some research out there, and the answer is pretty much no. It didn't play out that way. Well, it played out in a certain way. I think that's true. You cannot argue. I think everybody can observe that internet did equalize a lot of things, right? It equalized information access. A lot of materials, like if you want to access information and learning materials, is so much easier these days compared to before, when you have to go to a library and find a physical paperback book to find some information, right? So, and also everybody can create content, everybody can create something on the internet to sell, right? So that's an extreme equalization of a playing field in that sense. But if you look at what's actually where the internet exposure actually go to online, right? It still only goes to the top tier of brands or the products or the services that has the most exposure. So I can even say, traditional wisdom is like, maybe it's the, in sales, product sales, it's like 80-20, maybe like 20% of products occupies 80% of the sales volume. With the internet, it probably goes to 90-10. Now you have 10% of the top products and services that captures 90% of sales or 90% of eyeballs. And you see this on Amazon, you see this on Netflix, you see this on YouTube, you see that on Spotify, everywhere. On Spotify, yes, you can everybody can upload music these days, right? And you have recommendation engines that create some exposures, even if you don't do anything to promote your album. But the thing is, it definitely favors the brands, the top tier products a whole lot more, and gives those a whole lot more exposure. And because it's like the catalog is so long, the search cost is so huge now for people. So actually the average consumer, even they gravitate towards the top tier products and services even more compared to like a pre-internet age. So this is like a complicated reality that utopian internet vision did not play out exactly as described, right? So it played out in a certain sense, it played out, but it's not entirely as described. I think the same thing is going to happen in Web3. It's creating a lot of more opportunities for sure. Everybody can create an NFT. If you have the chops, you can bootstrap value for your assets, and you can issue a token and crowdsource the funding for your projects and whatnot. Everything is that playing field is being leveled, right? But at the same time, I think it's the same thing that's gonna happen as in the Web3 space. You will also have concentration where the best, the most powerful, the projects that get the most traffic are going to get even more traffic, get even more eyeballs and concentration of resources. So the world is not black and white. I see both are happening, will be happening in the Web3 space. Actually, this is something I'm gonna write about, is who win and who lose in the Web3 space. But that's for another day. So next question. Gosh, we're running out of time. Next question from MSC Blockchain. The proof of stake system is delegation of those who can afford to stake. Won't we end up where we started, where the larger the stake, more voting power? In other words, more money equals more stake and more influence. So this is the comment on what I was saying in my article, that you have these proof of stake chains. These what I'm saying is staking is going to be the third most important mechanism for value distribution, aside from wages and salaries and capital incomes, and such as interest and dividends paid. So traditionally, capital and labor incomes, those that I just mentioned, are the primary forms of value, of how you distribute the economic gains in a society to the participants, to your population, right? So, but blockchain has invented this third way called staking, which is really, I would say in a lot of cases, it's a more active format of capital income, or it's a combination of both providing a product, providing a service, because you're providing capital to secure something, on chain, to secure resources on chain, to enhance security on chain, or you provided a capital to, say, deposit insurance, or to improve the stability of a DeFi protocol. So it's really a combination of both a exchange of services, and also it's a capital income. And I expect that staking income is going to become the third most important way for us to distribute value to the population as a society. So this question is saying, well, staking, you still have inequality, right? So more people, they can stake more, so they get higher income. Yeah. What else do you expect? I don't think there's anything wrong with that. It's, again, this is not like it's not like the web3 is going to create a communism. It's still, any kind of capitalistic society. It's going to be a unequal society, because that provides the incentive for people to actually do something with their money or to get more resources, right? So you provide bigger capital. Of course, why shouldn't you have more say in the protocol, or in the, why shouldn't you have more influence in the project? I think you definitely should. It's just like, if you're a majority stakeholder of a company, if you have the majority voting power, you call the shots. You should have more power to determine the direction or the future of something. If you have more resources at stake, why is there anything wrong with that? So but what's different here is that I think with the staking, you're leveling the playing field, in the sense that whether you stake $1 or you stake $100 million, you get the same rate of return, right? And in the present system, in the current system, what we have, we don't even have that. What we have is, if you're a rich person, you get much higher return on your capital compared to if you're a poorer person, right? If you're a rich person, you have a lot more investment opportunities that are, potentially a whole lot more lucrative compared to the average person, who can only put their money in the bank, okay, in their savings account, which pays nothing, or they buy some common stocks, or they buy a house. So that's about it. What other opportunities do you have as an average average income or a poor person? But as a rich person, you have a much wider selection of investment opportunity that give you higher returns. But in the crypto world, if you stake your income, your income is at the same rate of return. Okay, at least that part is already a lot more fair compared to the current system. So, but I think if you stake more money, if you put more resources at stake, of course you get more money in return. You should. Why shouldn't you? Okay, so that's that. All right, should we do one more? Let's see. Next question, Antonio M. Why decentralization is superior to centralization? It's not. I know a lot of crypto people like I would say, this project is not decentralized, therefore bad. This project is not enough censorship resistant, therefore bad. I don't know why people say that. There are a lot of ideological bullshit in this space. You know, some people in like a web3 is like more religious than Catholic Church. It just tells you, you know, humans don't change. We need religion, whether it's Web 1, Web 0, Web 3. People will find some way to find to create a religion out of something. You know, centralized system, they are more efficient, they're more agile, they're flexible, they're cheap. There's nothing wrong with centralized systems. And also this is also some people say, okay, centralized system, not censorship resistant. But the thing is, censorship resistance is not a big deal. It's not really a big value prop of Web3, in my opinion. Okay, most people don't even care about censorship resistance. What you resist whom? Resist what? If you're in if you live in some miserable dictator, authoritarian country run by a ruthless dictator, yeah, sure, but that's a very small part of the world. Okay, that's definitely not a mainstream adoption use case. And also I don't know why people are trying to, you know, make it such a big deal about censorship resistant as towards government. I think excluding government from Web3 is extremely childish. In the US, you know, government employs 15% of people in the US. Okay, 15% of your friends and families and neighbors and whatnot, acquaintances work for the government and get paid by the government. They're a huge part of the economy. Okay. And why are those people your enemy? I don't understand. And also, the government sector is actually going to get bigger. Why? Because you have population aging. So government liability, is getting bigger. That's why, you know, every government is being deficit financed because, you know, obligations getting bigger. So. And also you have automation, you have, you know, robots taking away people's jobs, and this transition period, okay, eventually we go to a new equilibrium between supply and demand of jobs. But this transition period is not going to be exactly a smooth ride, okay? So I think you're going to see the public sector is going to get bigger because the government is going to have to take up the slack of where the market leaves out. Is what the market is going to do is it's going to shed more labors. Okay, so the the public sector has got to pick up the slack in some way. So that's why I think it's a trend you see in across the board in actually many countries, whether they are democratic countries or authoritarian countries, government is getting bigger. Okay, so it's not exactly someone's evil plot for government to get bigger, but it's, you know, the trend of our time. It's inevitable. Population aging, automation. These are two biggest trends driving the, you know, increasing size of the public sector, at least in this transition period. Okay, so I just don't think this is a value prop of Web3. The really significant value prop of Web3 is about the value accrual. It's about where the value is being distributed. So this is the merit I think you can argue of for decentralization. Is decentralization, it allows the value, the gains of the system to potentially be more evenly distributed compared to a centralized system. If you have a Facebook, if you have an Amazon in the world, you know, they run a marketplace, yes, but they capture most of the gains in the marketplace. Okay, so it's essentially only a small set of the population gets the gain. So that's the downside of the centralized system. To me, that downside is a economic calculation. So, but it's not a technology calculation. the fact is, technology-wise, centralized system more flexible, cheaper, easier to run, more agile. Okay, but the thing is, the decentralization of value accrual, I don't think you necessarily have to rely on the decentralization of technology. You could have a relatively centralized technology platform or a blockchain platform that runs the economic model of web3, which is more equal distribution of value, or allow more leveling, of playing field, of allow the economic gains of the system to be distributed to a wider set of the participants. So, but that doesn't necessarily go hand in hand with the decentralization of technology, I don't think. Okay, so the answer to why decentralization should be superior than centralization, the answer is it's not superior. And also, the second part of the question, if you let a company be managed by a community, the company will go under fast. Yeah. Unfortunately, anything need to be led by leaders, and the success ultimately depends on them, though. So, okay, I think what he's trying to say is basically companies managed by a community is no management. It will be a badly run company, which I don't disagree, okay? I think, again, right now, there's a lot of these experimentations about these autonomous organization, so-called DAOs, is at a very preliminary stage, okay? They really can't do much. This is not a way to manage a complicated organization. But they do have I think they do have their place in the sense that there are projects that are more straightforward to manage. For example, the kind of project that we already mentioned, such as like real estate investment, for example. You could have the community, the DAO community, vote on what houses you want to buy, okay? And you vote on the what houses to buy, what is the amount, and you buy those houses, you rent those houses out, and you have the payouts completely done on chain and completely automated, with the parameter changes only happen when there is a vote on their changes. Because this type of organization has a very specific set of function. It's very simple, okay? It's very straightforward, and the value of being trustless is so much greater than the value of some kind of discretionary decision making. If that is the situation, then sure, the DAO model is superior. So I think that's why I think for some investment projects, this is probably a kind of organizational structure that can work better than a traditional company. But is this going to replace traditional company structure? I don't think so. I think they're going to coexist, but this is the more primitive, more simpler form of a simpler way of organizing human activities. Still, okay, we're really running out of time. The last question, really fast, because someone is asking again from John T. What are your top 5 projects that you think will succeed when the crypto market grows more? I think I already answered something like this. Maybe like 1 or 2 videos ago, because someone I remember asked like what's my top 4 projects, something like that. I don't think in a nutshell they haven't changed a whole lot, okay? But just let me just like do a quick recap. I think at this stage, right, basically you have Web3 in a very primitive emerging stage of development. You don't have a whole lot of on-chain real use cases yet, except some DeFi NFT stuff. And a lot of these things are extremely hyped, right? So I think the best investment will be in the infrastructure space, which means you have your layer 1 and layer 2 of the world, and you have these all the other infrastructures, such as, the what's immediately coming up this year is the interoperability and the, multi-chain scaling, the composability, cross-chain, that kind of projects. So, and also cross-chain bridges. So all these different segments of the infrastructure space, that's number one. I think you should pay attention to. So the layer ones, aside from your Ethereum, Bitcoin of the world, which, different people have different opinions about them. But aside from that, I think you have the layer ones that I'm most optimistic about is still Solana and Avalanche. The reason being, I think Solana is going to corner the market for the type of use cases that requires platform-wide stay sync and platform-wide easy composability. Maybe that's 10-15% of all the crypto project use cases that happen in the future. I don't know. But even that is a huge market, right? I think Solana is going to corner that market because everybody else is trying to go modular. And modular chains, and you sacrifice some kind of you sacrifice composability and interoperability to some extent, okay? So I think that's why I think Solana is going to corner that one part of the use case. And also this is, it's the L1 that has the most adoption right now. And by the way, I'm not holding Solana and Avalanche tokens right now, just to be completely open with you, okay? But I do think, because I think there are better opportunities in the short term, because those are already pretty big. But in the long term, what I'm saying is, if you're asking me what would be my long term bet, if I think about what would be most sustainable in the long term, that those two I think will be my current best bet. And Avalanche also, I think it's got it's technology wise, it's got a better performance than a lot of other other alternative layer ones, and they're rolling out their so-called subnets, which are essentially modular blockchains, essentially, separate blockchains, individual blockchains that use the Avalanche consensus protocol, share the same set of validators, but it's running, it's its own project-based blockchain, right? So they're going to roll out those this year. That hasn't got a whole lot of traction yet. I'm sure there's some usability issue, UX issue, roadblocks that they're going to need to overcome for this to become a thing. But theoretically, conceptually, I think this is going to be the direction of the future for most of these blockchains, which is going to a modular or app chain structure, so app-specific chain structure. So that I think if you're interested in the project, you should keep track of how their subnets progress, whether it get traction or not. Right now, I'm not seeing traction. It's unproven, okay? But I think the concept is aligned with where the blockchain space is going to go in the future. Other type of infrastructures will be things like, bridges. I think I also mentioned before, Synapse, multi-chain, those, cross-chain bridges that you can look into. And small cap projects that are in the infrastructure space that I already mentioned before, Juno, Octopus, which are on Cosmos and Near, that you can check it out if you're interested and know more, but do your own research, right? Because those are small cap. You don't want to bet a whole lot on those, as we already talked about before. This is like moonshots. You don't want to bet a house on those, right? And also, what else? And another type of infrastructure that I'm also optimistic about is something like Pocket Network, which is a decentralized RPC service. Essentially, it's a decentralized competitor of service like Alchemy and Infura, right? So basically, it allows blockchain applications to actually communicate with the blockchain by sending these requests, like you send your API request from web app to your backend, roughly speaking, okay, without actually running the chain, without actually running a node of the actual chain. So which is most of these blockchain apps do. They don't actually run the node of the chain that they run on, right? And also, if you're running, if your app is multi-chain, it gets even more complicated. So these services, these RPC services, provide that kind of convenience for applications. And Pocket Network is like a decentralized service, decentralized RPC service. I think they're getting some good traction, so you can check it out, that too, in the infrastructure space. Okay. I think, what else? Okay, aside from infrastructure, which I also mentioned before, stable coins, algorithmic space stable coins, Frax and Luna, those I'm also, I think those are that industry, that sector is promising. Whether there's specific projects will prevail, that is the question. Okay, and then obviously gaming. The GameFi and the blockchain gaming of the world, which is so hot right now. But the downside is these projects, they don't have, it's like right now this space, it has so much noise. You just, it's very hard to tell good projects from bad. So I'm still optimistic about the DeFi kingdom, and I have some stakes in Gala, and in another project on Arbitrum called Magic, things like that. But they're pretty all pretty small. So, but there are a lot of these gaming projects. There are so many of them these days. But if you invest in any of those, I suggest you actually use the project, you actually play their games. And to evaluate the opportunity yourself. Okay, so that's all for today. I will talk to you next time.